Hi, welcome back to Joe Blogs. In today's episode, I want to talk to you about what's happening in the economy in China, and specifically to talk about accusations that are now being made that China has hit a level of overcapacity in terms of its manufacturing. Now, you might be sitting there thinking, what's overcapacity? What are you talking about? Well, this comes down to simple economics. If you produce too much of anything, then you're going to have an imbalance in terms of supply and demand. And hopefully, if you've been watching the channel long enough, you'll know that when there's an increase in supply and no proportionate increase in demand, then that tends to reduce the price because you've got too much and therefore you have to cut the price in order to encourage people to buy them. And that's exactly what's happening right now with a lot of different manufacturing businesses in China. And unfortunately, this isn't just bad news for the Chinese economy. This is potentially bad news for the whole of the global economy. So in today's episode, I'm going to look at 3 different industries where China has a dominant position globally. We'll have a look at what's going on with electric vehicles because China's electric vehicle production has exploded over the last few years. And in the final quarter of 2023, the Chinese car manufacturer BYD actually overtook Tesla as being the world's most successful electric car brand. It sold more cars than Tesla in the final quarter. I think Tesla have actually taken that position back in the first quarter of 2024. But it shows you how rapidly that brand has grown. And I will bet that a lot of people watching this video haven't even heard of BYD as a brand. We'll also have a look at what's going on with solar panels, because this is another field where China has completely dominated the market. It's estimated that around 80% of all solar panels manufactured globally have been made in China. And we'll then go on to talk about the situation for lithium-ion batteries, which also are used in electric vehicles, but are used in a variety of other different applications. And China currently has a dominant position. It supplies around 75% of all of the lithium-ion batteries globally. So we'll talk about what's going on in those industries. We'll then talk about what's happening with Chinese businesses because more and more of them are now posting losses. They're actually not making any profit. And obviously that's a major problem for any company. But in China, we've now got a huge amount of these companies. And it's going to be interesting to see what the Chinese authorities do about that. We'll talk about what's happening in the Chinese economy itself in terms of prices. We'll have a look at the factory gate prices and inflation because that's really part of the problem with this overcapacity. And then finally today, I'll wrap up with my summary as to what I think is going on in the Chinese industry right now, what the implications are for the Chinese economy, and also what the major implications could be in 2024 for the global economy. But before we get started on all of that, I'd like to say thank you so much to everyone that's supporting the channel. I know I've said this before, but I genuinely mean it. If you've sent me a YouTube super thanks or bought me a coffee over the course of the last week or so, thank you so much for the time and effort that you've taken to do that. Really, really appreciate it. And if you've signed up as a long-term supporter, either through Patreon or Buy Me a Coffee membership or YouTube membership, thank you for that support. Really helps to keep me going, keeps me motivated, and keeps me making more videos on a regular basis. So thanks. As I mentioned at the start of today's video, there are now growing concerns that the Chinese manufacturing industry has hit a level of overcapacity. And before we go on to talk about some of the industries in detail, I wanted to touch on what overcapacity is and why it's bad news in terms of your economy. Overcapacity relates to the supply of any product. So if you're manufacturing something, you need to make sure that there's sufficient demand. You make 1,000 of a certain product and you need to sell 1,000 of that product to make your profit. Now, if you increase your production from 1,000 to 10,000, you need to make sure that either there is a tenfold increase in demand if you're the only supplier, or that your product is going to be more attractive to the market. So the extra 9,000 that you produce potentially will displace 9,000 of somebody else's product. And when you have a situation where everybody in an industry is suddenly increasing their supply, they're increasing their manufacturing and therefore pushing lots more product into the market, you can get to a situation where you hit overcapacity, where demand is actually saturated. Everybody that wants to buy has the ability to buy it. There is enough product. And when you get to that situation, what happens if you keep producing more and more product is basically you've got oversupply, and therefore supply outstrips demand. And as we've talked about thousands of times before on the channel, when you get an imbalance between supply and demand in that way, it will drive down the price, because the only way to get rid of that oversupply is by reducing your price to the point where you encourage people to buy more. And that's the situation that the world now believes that China has got to in terms of its manufacturing output. It's producing too much of certain types of product, which are now flooding the global markets and run the risk of driving down prices. And the problem that this presents to the global economy is that China, unlike some of the other countries in the world, is not working on a truly economic basis. If you have a situation in the USA where 10 firms suddenly double their output and demand doesn't move, all that's going to happen is the price will fall for all of those products. All of those 10 companies will then make significantly less profit because they've had to cut their sales price. Some of them actually might start making losses, and therefore they could go bankrupt, become illiquid, and disappear. And eventually the market will sort itself out, because those weaker companies will be taken out, and at the end of the process you may be left with only 2 or 3 manufacturers, and the other 7 or 8 might have gone bust. But the problem that we've got with regards to Chinese manufacturing is that a lot of companies are being supported by the state. So rather than letting these companies go bankrupt and disappear, therefore reducing supply and bringing the market back to equilibrium, if China decides to subsidize those companies either by giving them cash or providing cheap loans or some other form of subsidy, then that will keep those businesses in business. They'll keep trading, and that potentially could force other businesses in other countries out of business. So from a global perspective, there is a risk that the Chinese businesses force prices down to a level where it becomes uneconomic for a lot of other countries to actually keep producing these products, and therefore we're only left with Chinese suppliers at the end of this game. And that's the concern that's now rising globally. Electric car sales are growing rapidly all across the world. In 2023, over 14 million electric cars were purchased, which represented an increase of 35% against the figure for 2022, and is up more than 6 times against the figure sold in 2018. And China has taken a big slice of the new electric car market. This chart shows the increase in the global electric car stock between 2013 and 2023. And as you can see, over the last 10 years, there has been a rapid increase in the total number of electric cars on the roads. And if we have a look at the bar chart for 2023, it shows us the breakdown of where those electric vehicles are located. The blue section at the bottom represents the number of electric vehicles in China in 2023. And as you can see, the total number is around 16 million, which represents around 40% of all electric vehicles on the roads. And when you take into account the next section, the light blue section, which are basically hybrid electric vehicles in China, the combined total of electric and hybrid electric vehicles is more than 53%. The European market is the next fastest that's adopted electric vehicles, with electric cars representing around 15% of the total global supply, and electric and hybrid representing around 23%. And in the USA in 2023, there were around 3 million electric car sales, which represented around 7% of the total global market. And this chart, which is based on global electric vehicle sales in the last quarter of 2023, shows us which countries have adopted electric vehicles the fastest. And as you can see right at the top of this chart, in Norway in the last quarter of 23, almost 80% of all cars purchased were electric vehicles. The next highest adopter was Iceland, with 58% of all vehicles being electric, followed by Denmark at 45%, Sweden 40%, Finland and the Netherlands 35%, Ireland 34%, Belgium 25%, and Portugal, Switzerland and China all came in at 24%. But if you have a look at the absolute number of vehicles, you can see why China is such a big player. Because although they only made 24% of their total car sales in the electric market, that equated to almost 1.9 million vehicles, which is more than all of the other countries ranked above them put together. And if we pick out a few other selected countries, in the UK in the final quarter of 2023, almost 18% of all car sales were electric, which equated to around 80,000 vehicles. In Australia, it was 9.5%, equating to around 22,000 vehicles. In Canada, it was 9.4%, equating to 38,000 vehicles. And in the USA, it was 8.1%, equating to 314,000 vehicles. Which means that electric vehicle sales in the final quarter of 23 in China were around 6 times the total sales in the USA. And this chart shows the top 10 brands by market share in 2023. And as you can see, right at the top of this list is Tesla, with a market share of 19.9%. However, it was closely followed by BYD, the Chinese manufacturer, that held 17.1%. And as I mentioned at the start of today's video, in the final quarter of 2023, BYD actually achieved higher sales than Tesla. The third largest brand by sales is GAC Icon, which is also Chinese and held a 5.2% share. The fourth largest brand was another Chinese business, SAIC GM Wuling, which held 4.9%. Number 5 and 6 were two German manufacturers, Volkswagen and BMW, followed by the South Korean brand Hyundai, the German brand Mercedes-Benz. Number 9 was MG from China, and at 10 was the South Korean brand Kia. So what this chart shows us is that 4 out of the top 10 brands globally in 2023 were Chinese. However, the manufacturing actually is more centric in China, because in 2023, over 50% of all of Tesla's vehicles were actually manufactured in China. Now, in terms of addressing the issue of overcapacity, this chart shows the percentage movement in both the volume and the value of electric vehicle sales by Chinese manufacturers, dating back to 2020. The red line shows the percentage movement in volume of sales, so number of vehicles, and the yellow line shows the percentage movement in the value. And the scale on the left-hand side of this chart is shown as a percentage and goes from minus 100% to plus 700% at the top. So the scale is really quite wide here. So we start off by looking at the red line, which shows us the number of vehicles, the percentage movement each year. You can see that in 2020, which was the year when the globe was affected by the COVID-19 pandemic, there was a sharp fall in the volume of electric vehicles sold by Chinese car manufacturers. It was down at its lowest point by around 60 or 70% midway through 2020. However, as the globe started to come out of the COVID-19 pandemic, demand for electric vehicles rose once again, and you can see that the red line then moved back into positive territory. And then in 2021, there was an explosion in the sale of electric vehicles manufactured by Chinese companies. And you can see that at one point, it rose to almost 700%. So that means there was a 7 times increase in the total volume of sales. And throughout the rest of 2021, the sales growth remained extremely high, moving between 100 and 200%. At the start of 2022, following Russia's invasion of Ukraine, when there was a lot of uncertainty globally, the percentage increase in sales actually fell back down to around 0 briefly. However, by the middle of 2022, it was back up at around 100% increase. And then in 2023, we saw another sharp increase in the sale of electric vehicles manufactured in China. It rose above 300% in the first half of the year. But interestingly, if you look at what's happened in the second half of 2023, the increase in the volume of sales has reduced significantly. And the current position for the first quarter of 2024 is that there is virtually no increase in volume sales. If we now have a look at what's been happening with the value, you can see that in 2020, there was a sharp increase in the value of those sales to the Chinese car manufacturers. It was moving somewhere between 100% and 300% increase. Now that is an incredibly high movement in terms of the value of any product. And this tells us that there was high demand for those sort of vehicles and people were prepared to pay high prices. And that situation continued throughout 2021. And in fact, towards the end of 2021, you can see that the yellow line touches almost 600%. So that represents an increase of around 6 times compared with the previous year's price. In line with what we just discussed in terms of volume of vehicles, the value also fell following Russia's invasion of Ukraine. However, as you can see, it soon recovered, and by the end of 2023, Chinese car manufacturers were still seeing an increase in value of around 100%. That increased dramatically in 2023, when at one point it rose above 550%. And these are huge numbers for any manufacturer. However, if you look at what's happened over the last 6 months, there has been a dramatic fall in the value of these electric vehicle sales. And the year-on-year movement right now is sitting at 0%. And this indicates that potentially the market has become oversaturated. There is overcapacity. There are too many options in terms of electric vehicles that you can buy, and therefore prices are now starting to come down. The rapid growth in the solar power industry in China has led to a commensurate increase in the usage of solar power right across China. This chart shows the total installed solar PV capacity for China, the European Union, the United States, India and Brazil for 2022, 2023 and 2024. And what this shows is that over the last 3 years, the installed capacity in China has grown rapidly from 100 gigawatts to more than 160 gigawatts, which is more than 3 times greater than the whole of the European Union, more than 5 times the amount of installed capacity in the USA, and is actually more than the whole of the rest of the world added together. And this chart shows a breakdown of where those solar panels are actually being manufactured. The light blue section on this chart represents China, the dark blue section Europe, the light green section North America, the dark green section the rest of Asia Pacific, the yellow section India, and the brown section the rest of the world. And what you can see from this chart is that the light blue section dominates virtually every bar on this chart. However, in terms of discussing the issue of overcapacity, this chart shows us the actual and projected supply of solar panels versus the expected demand. The bar charts shown for each year are broken down into 4 different categories: modules, cells, wafers and polysilicon. And the 3 different coloured lines from 2023 onwards show us 3 different demand scenarios. The red line shows us the accelerated case demand. So basically, if everybody starts ramping up their solar panel installation. The orange line shows us the expected demand in normal circumstances. And the black line, which is running almost at the same level as the orange line, are the expected level of installations. And what this chart shows us is that there is going to be significant overcapacity in the solar panel market over the next 5 years. You can see that the bar charts by far exceed where the expected demand is. And once again, here we've got a situation where China is producing products into a market where there's actually not enough demand to actually purchase all of those products that are being made. And what that will mean is that the price of those products will fall because there's overcapacity, oversupply. And as we discussed earlier in the video, when you get a situation like this, you may find that companies start making losses and go out of business. And this chart, which is based on the same data that we looked at previously for electric vehicles, shows us the percentage movement in the volume of solar panel sales coming out of China and also the value. And what we can see here is that the red line has fluctuated wildly over the course of the last 4 years, moving from times when it's been hitting high percentage increases, over 80%, but also has been dropping below zero, so has actually seen a fall in volume. And if we look at the situation for the first quarter of 2024, you can see that there's been a considerable increase in the volume of sales, and it's now up at around 45% year on year. However, if we look at what's happened to the value of those sales, you can see that there's also been some quite wild swings. And as you can see from the movements of the yellow line in 2021 and 2022, there were times when the value of those sales from Chinese manufacturers were above 100%. So this is obviously representing a very strong market. However, if we look at what's happened in 2023 and the current quarter, you can see that the yellow line has actually dropped into negative territory. So the value of those sales is falling. And in the first quarter of 2024, it's down by more than 30%, which is traded off against the huge increase in volume. So what we're seeing here is that Chinese manufacturers are chasing volume sales rather than value. They're happy to sell more quantity at a lower price in order to keep shifting the product. And that represents bad news if you're operating in this market, because you're up against Chinese manufacturers who are happy to keep cutting their prices in order to get those volume sales. And to highlight the fact that this isn't actually good news for the Chinese manufacturers either, these charts show the movement in the share price of 4 Chinese solar manufacturers dating back to January 2022. And what we can see here is a consistent trend for all 4 of these companies, where they've seen a huge fall in their share price over the course of the last 18 months or so. And this is as those companies continue to chase volume sales at the expense of value. In terms of lithium-ion batteries, it's currently estimated that China has a market position of over 75%. It's making 3 out of every 4 lithium-ion batteries that are sold globally. And that dominant position is expected to continue over the course of the next few years. This chart shows the estimated breakdown of the top 10 lithium-ion battery manufacturers globally in 2027. And as you can see, China is still at the top of this list and is expected by 2027 to retain a market share of around 69%, followed by the USA at around 10%, Germany at 6%, and then we have a whole host of other countries with around 1 or 2%, Hungary, Sweden, Poland, Canada, Spain, France, and Mexico. And in terms of the issue of overcapacity, whether or not China is producing too many lithium-ion batteries, this chart, which is the same as the previous 2 that we've just looked at, shows us the volume and the value of the lithium-ion battery sales coming out of China dating back to 2021. And what you can see here in terms of volume is that following an initial spike in 2021, when volume sales increased by around 140%, there has been a significant downward trend. And in the second half of 2022 and throughout 2023, Chinese lithium-ion battery manufacturers struggled to increase their volumes. A lot of their sales were actually in negative territory. Now, that situation did reverse briefly and minorly at the end of 2023. However, in the first quarter of 2024, year-on-year volume sales are entirely flat, so there's been no growth whatsoever. And if we look at what's happened with the value of those sales, it follows a similar trend. There was a spike at the beginning of 2021 as the world came out of the COVID-19 pandemic, and the value of sales increased by more than 200%. The year-on-year movement in the value dropped down to around 80% throughout the rest of 2021 and 2022. However, in 2023, there was a significant fall in the year-on-year movement in value. And in the first quarter of 2024, the value of those sales has moved into negative territory. So once again here, what we are seeing is the Chinese manufacturers are chasing volume at the expense of value. They're happy to cut their prices to achieve higher sales. And that's going to represent really bad news for anybody that's competing with them. These 2 charts show us the growing number of loss-making manufacturing businesses in China dating back to 2014. If we start off by looking at the chart on the left, the scale on the left-hand side is measured in thousands and shows us the total number of industrial enterprises. And the bar charts are split into 2 colours. The red section at the top is the total number of profitable enterprises, and the yellow section at the bottom are the total number of loss-making enterprises. And what this shows is that over the course of the last 9 years, there has been a consistent increase in the number of loss-making businesses in China. It's on the rise as a result of the fact that a lot of these companies are now getting to the point of overcapacity. They're producing too many products for the market, and therefore they're having to cut that sales price, and by doing that, they're going into loss-making territory. And the chart on the right-hand side shows us a percentage breakdown of all businesses in China. And the scale here is a percentage from 0 at the bottom to 40% at the top. And once again, you can see that there is a consistent and rising trend in terms of the percentage of loss-making businesses in China. And in 2024, the percentage of loss-making enterprises is somewhere between 25 and 35%, which means that 1 in 4 or even 1 in 3 of all companies in China are currently banking losses. And obviously that's entirely unsustainable unless the state is prepared to fund all of these companies to keep them in business. Now, in terms of talking about subsidies and the way that the Chinese authorities are actually supporting these loss-making businesses, it isn't just a situation whereby they're handing them large chunks of cash. They're not just making up for all of their losses, giving them grants. What they're doing is allowing them to access low-cost debt, which keeps the businesses alive. They can pay for all of those losses and keep funding their businesses by taking on more and more debt, which is essentially being sponsored by the state. This chart shows the year-on-year percentage movement in lending to the manufacturing sector and the property sector in China, dating back to the first quarter of 2020. The scale on the left-hand side of this chart goes from minus 5% at the bottom to plus 40% at the top. The red line shows us the percentage movement in lending to the manufacturing sector. The yellow line shows us the percentage movement in lending to the property sector. And the black line shows us the total percentage movement in lending. And what this shows is that over the course of the last 4 years, there's been a significant percentage increase in lending to the manufacturing sector at the same time as the percentage lending to the property sector has fallen. And if you follow the channel, you'll know that we've talked about the property sector in China at length. There are major problems right now, and the government is pulling back from that sector. But what seems to be happening here is that they're encouraging the banks to provide that debt directly to the manufacturing businesses. And interestingly, as we've just discussed, it now appears that 1 in 4 or even 1 in 3 of those businesses is making losses. And the way that they're funding these businesses is through the provision of cheap debt. One other issue I thought was worth covering at this point is what's going on with factory gate prices. What's happening to the price of those products as they leave the factories in China? And this chart shows us the year-on-year movement in factory gate prices over the last 12 months. And what this shows is that in every single one of the last 12 months, there has been a fall in the factory gate prices. This time last year, factory gate prices were down 3.6%. They actually peaked at a fall of 5.4% in June 2023. And in March 2024, the year-on-year movement was a fall of 2.8%. And what this tells us is that Chinese manufacturers are not able to increase their prices. They're having to continually cut their prices as a result of the fact that there is overcapacity in the markets that they're supplying. There simply isn't enough demand to be able to increase their prices. And if we have a look at what's been happening with prices in China as a whole, over the last 12 months, China has actually been suffering from deflation in 5 of the last 12 months. And in the months where China has actually experienced a positive increase in inflation, it's been at very low levels, less than 1%. And this tells us that there isn't sufficient demand in China to be able to buy all of the products that are being produced, and therefore it once again indicates that there is overcapacity in China. So what's the summary and conclusion today? Well, I wanted to post this video because I think the issue of overcapacity is really quite interesting and very concerning. Up until this point, we've been talking about China struggling in terms of its exports and struggling to get its prices up in its home market because of the deflation that we've just seen in terms of the inflation figures. But what we're now talking about is the fact that Chinese businesses are continuing to manufacture the maximum amount of products. So they're still carrying on as if nothing is happening. Normally in these sort of situations, if you have a business that's having to fund itself, if it starts to see falling sales and falling prices, that company will start losing money, and that won't continue indefinitely because there comes a point when you can't pay your bills, you can't pay all of your debt providers, and therefore you become insolvent, bankrupt, and your business is closed down. And you get taken out of the market, which reduces the amount of supply that's coming into the market because there's less manufacturers. And at some point, the market will return to equilibrium and you'll start seeing increases in prices and companies will start making profits again. That's how capitalism works. It's dog eat dog, the survival of the fittest. That's how business operates and how it's always been. But the problem that we've got with regards to the Chinese situation is that firstly, these companies are absolutely huge. They're producing massive volumes of product. That's what they've been geared up to do. They supply the whole of the world. And in the industries that we've talked about in today's video, the electric car industry, the solar panel industry, and the lithium-ion battery industry, China is dominant. It's grown its capacity rapidly and is the world's largest supplier. But the problem that we've got is that these businesses are now starting to lose money because there isn't sufficient demand to be able to buy all of their products. So electric car demand has risen rapidly. As we talked about, in 2023, there was an increase of around 35% globally in the purchase of electric vehicles. But unfortunately, the increase in Chinese capacity is outstripping that increase in demand. So there are more and more vehicles hitting the market, more and more options. And as that continues, prices are falling. And this is something that both Europe and the USA have complained about already to China. They've said that the state is subsidizing these companies, keeping them alive in order to keep them producing more vehicles. But the problem with that is that they're killing the market because the European and US manufacturers are struggling to be able to compete at the same level in terms of the price. So we've got a situation where the overcapacity in China is actually affecting the global market. And obviously that's good news if you're a consumer for the short term because prices are going down and you've got lots of choice. But in the long term, this could be really quite damaging because although the Chinese businesses are finding that they can stay alive even though they're making losses because they're being given access to cheap finance, which keeps them funded, European and US businesses won't be able to do that. And at some point, if you continue to post huge losses, your company will have to be restructured and possibly downsized. So the overcapacity that's coming out of China right now is really bad news for those Chinese manufacturers because they're making losses. But it's really bad news also for the global economy because what we might see is a lot of businesses struggling to make profits because their markets have been flooded and prices have fallen. And that means that those companies will post losses, their share prices will go down, and this potentially could trigger a recession in both Europe and the USA if we continue to see this level of overcapacity driving down prices and breaking these markets. So the overall summary of today's video is that Chinese manufacturers do appear to have hit this level of overcapacity. We've seen it from today's data. A lot of businesses in China are now posting losses. Those losses are being supported by the state in various different ways. So these companies will continue trading. That's driving down profits, that's driving down prices, and potentially could have a really devastating impact on a lot of businesses in the West. So hopefully you've enjoyed today's video, you found it useful, informative and thought-provoking. If you've liked what I've said, then please give me a thumbs up. Thank you for watching this video all the way through to the end, and here's something to put a smile on your face.